Hello, this is Les Goldstein here, and I want to welcome everyone to this special beginning of the fourth quarter video conference call. I'm the owner and president of Personal Financial Strategies Incorporated, located here in Park Ridge. Our broker-dealer is Sigma Financial Corporation, member FINRA, which is the Financial Industry Regulatory Authority, and the Securities Investor Protection Corporation. My firm, Personal Financial Strategies Incorporated, and Sigma Financial Corporation are independent from each other, independently owned and operated. So thank you all for joining us today. I'm very excited to be able to share some important information with you. We love talking about important market events and how they impact our clients and how we can add value to your lives in this space. For today's call, I'll be focusing on major events that took place in the third quarter and looking ahead to what might be coming in the fourth quarter of this year, 2013. Before we get started, let me get some important disclosures out of the way. Investing involves risk, and no investment strategy can guarantee a profit in a declining stock market or guarantee protection against loss at the same time. While we believe the information to be presented in this call is accurate, we will not guarantee its accuracy. Opinions expressed by me in this call are subject to change without notice and are not intended as investment advice or the solicitation to purchase or sell a particular investment security. Please consult with us here at PFS before making any kind of investment decision. With that, let's get started. First of all, a little wrap up for the third quarter. The word for the third quarter was volatility, that roller coaster ride that we're also aware of. Market fears caused by our involvement in Syria, the uncertainty at the Fed, and budgetary debates in Washington all contributed to the volatility in the third quarter. Despite that, the market still turned in a solid overall performance. The S&P 500 and the Dow were both up 4% for the S&P 500 for the quarter, 1% for the Dow, and the NASDAQ gained 9.25% in the third quarter of 2013. On the economic side of things, we had a reasonably decent quarter. Major indicators show that the economy was still growing, although at a more modest than expected or desired pace. Estimates of third quarter gross domestic product were revised downward slightly, although we're still expecting third quarter growth above the 2% level. On the other hand, second quarter gross domestic product, or GDP, was revised upward to 2.5% due to an unexpected increase in U.S. exports. Despite some worries about mortgage rates, the housing sector is still doing well. Home prices are up across the nation, and home sales continue to grow. The labor market continues to improve. Inflation and unemployment appear to be under control, with unemployment dropping to 7.3%. Hiring does remain below healthy levels, and people are still dropping out of the job hunt, meaning there's still some work to be done and some improvement that can be had in the unemployment space. On the negative side, consumer confidence or consumer sentiment in mid-September dropped to a 5-month low due to consumer worries about high interest rates and the never-ending drama in Washington. It's nice that the economy appears to be strong enough to withstand a gradual shift away from the ongoing Fed buying, where the Federal Reserve continues to buy approximately $85 billion in bonds every single month, propping up the economy. Although we are very happy that the Fed is taking a cautious approach, and the market reacted positively, it seems, to the incoming new Fed chairperson replacing Ben Bernanke. The Syrian crisis also caused volatility in the U.S. stock markets in August and September as investors worried that the United States might become embroiled in another Middle East conflict. Rising tensions and the use of chemical weapons against civilian targets led the Obama administration to consider military intervention in the Civil War. Fortunately, cooler heads prevailed, a diplomatic solution was reached, and Syria has committed to surrendering its stockpile of chemical weapons. Meetings with Syrian officials have begun, and we hope that military action will be avoided, as this, of course, is not good for the world or our pocketbooks here back at home. As we see it, here come the following fourth quarter challenges. To give you a refresher, one thing we need to be worried about is the debt ceiling. The U.S. reached its debt ceiling limit, which was a limit set by Congress on the amount that the government can borrow on December 31st, 2012. You may remember that as part of the fiscal cliff, that debt ceiling limit was put in place. Since then, Congress has repeatedly decided not to raise the debt limit. One of the consequences was sequestration, which was a $1.2 trillion worth of mandatory across-the-board federal budget cuts, which went into effect on March 1st. Since then, the Treasury Department has managed to keep the bills paid through a combination of high tax receipts, for example, Social Security taxation, and what they call extraordinary measures. These measures have now run out, and the Treasury Department has notified Congress and the President that it won't be able to pay any more bills beyond mid-October. Now we have extended the debt ceiling, and we've given ourselves some breathing room, and that is, of course, buying Congress some time to work its way out of this situation. I'd like to clarify something that may be not clear to you before this call. Keeping the debt ceiling where it is isn't really about controlling government spending, because the debt that's issued by the Treasury is used to pay bills that Congress has already authorized. It would be like trying to run your household by refusing to pay a credit card bill for items that you've already purchased. It simply doesn't work. The reason that the debt ceiling issue is so much more serious than the government shutdown that we recently avoided is that we pretty much know how to deal with a shutdown, but the government has never dealt with a debt ceiling breach before, and there are no official contingency plans in the event that debt ceilings aren't permanently extended. While the country reaches the debt limit, the Treasury will no longer have the legal authority to borrow any more money to close the gap between spending and tax revenue. If Congress doesn't vote to raise the limit, either temporarily like we did or permanently, and the recent budget situation makes it less likely that lawmakers will continue to work on this in a agreeable and bipartisan manner, in my opinion, the President will have three basic options. Option number one, President Obama could decide that the government's legal obligation to spend trumps the debt ceiling, and he can order the Treasury to sell more bonds. This option would probably cause some very serious political turmoil or chaos in Washington. Option two, the President could instruct Treasury to pay some of the government's bills and ignore the rest. We could call this a triage option. Option number three, and one we certainly don't want to look at in any way, is the government could go into default and not pay anyone. This is definitely the worst option. It may have serious financial ramifications for the global economy as well as here at home. A default like this would mean that the U.S. would stop making payments on U.S. Treasury bonds, bonds that are meant to be one of the safest assets in the financial system worldwide, because they are backed by the full faith and credit of the U.S. government. There's also the issue of the United States sovereign credit rating, which may be affected by a protracted debate or any missed debt payments. 2 years ago in 2011, during another fiscal standoff between Congress and the White House, Standard & Poor's stripped the U.S. of its AAA credit rating, and they may be willing to do it again. The reason this matters is that the lower the sovereign credit rating is, the more the interest the United States has to pay to its creditors, making it increasingly expensive to borrow, which could add to the country's debt problem. The next challenge we need to talk about is known as Federal Reserve tapering. While Fed Reserve tapering has gotten lost in the furor over budget talks and the debt ceiling, we still expect a tapering decision to affect the stock markets. How much it affects investors really depends upon how the Fed decides to manage the process. As long as the Fed sticks with a gradual taper, it's unlikely that markets will be impacted too much. Realistically, given how cautious the Fed appears to be, it's unlikely that they will turn off the money spigot suddenly. Whether tapering starts in October, November, or December, it's not likely to be a smooth process. More likely, the Fed will cut back a little, see how it goes, and then adjust the process. There's no guarantee that the Fed will even taper this year at all if it doesn't think the economy can handle it. That means that the Fed, in one way or another, will continue to be buying back bonds, whether it's to the tune of $85 billion a month, is of course something you need to consult your crystal ball to get a better answer. What we do know is that Wall Street tends to get a little nervous around Federal Open Market Committee meetings, and we can expect more volatility as analysts try to predict which way the Fed will go. As I mentioned earlier, we here at PFS believe that the economy is strong enough to withstand a gradual tapering process and that a lot of the uncertainty is already priced in by investors. The market tends to be anticipatory in discounting future events to the present. However, markets could react badly to any unexpected surprise. Wow! With all these headwinds facing the market in the next few months, it might look like there's no way for this rally to continue. Well, we don't think here that that's necessarily the case, and we actually see significant potential for upside in the fourth quarter of 2013. Here's why. Number one, long-term economic trends are still positive. Hiring is improving, business spending continues to grow, and economists estimate third and fourth quarter gross domestic product growth at 2.2% for the third quarter and 2.3% for the fourth quarter, respectively. The housing market also remains a major contributor to economic growth, even with currently rising interest rates. The global economy is improving. Trends in China and Europe suggest that our largest trading partners are pulling out of the doldrums, and we can hope that global demand for U.S. goods will continue to pick up. We can also hope that the third quarter earnings season, which is upon us right now, provides us with some positive surprises. It's impossible to predict which way markets will move with any certainty, and we always recommend focusing on long-term financial objectives instead of short-term market movements. It's probably no surprise that we can expect more volatility in the fourth quarter of this year. However, one of the benefits of volatility is that it often presents opportunities for flexible investors, and we focus on finding and exploiting those opportunities for our clients. So, to wrap it all up, I want to thank all of you for joining me today for this call. I greatly appreciate your time and hope you enjoyed this review of some of the important economic issues facing the markets this year. If you have any question about the information that I presented, or that you might have some questions or concerns that didn't get answered, and you'd like to know how these decisions and issues impact your personal financial situation, please call me or Robert or Jean or Yvonne at 847-268-3670, or email me directly at lgoldstein@sigmarep.com. The letter L, my last name Goldstein, at sigmarep.com. I'll do my best to answer your questions, or we can set up a time to discuss these issues with you. As always, it's my pleasure to be of service to you and your family. With that, thank you and have a wonderful day. Les Goldstein signing off.